Hello, everyone, and welcome to another great webinar from CPA Academy. Thank you for joining us today. My name is Gabe, and I'll be your moderator for today's webinar, Tariffs and Transfer Pricing, How to Stay Compliant and Avoid IRS Scrutiny. Our presenters today are Eric Tuthill and Cheri Valerio. Before we get started, I wanted to go through some housekeeping items and do some technical checks just to make sure that everything is working. First, if you don't mind going to the Q&A tab on your control panel, and please let me know you can hear my voice and see the title slide. Feel free to let us know one thing you'd like to take away from today's webinar. If anyone has any technical issues today, please let me know in that Q&A tab. I will do my best to get around to everybody as quickly as possible. This is also where you can post your questions and comments for our presenter in the Q&A, and we always love getting those, so please feel free to use that. And I see them coming in fast and furious from all over the country, so thank you so much. Now that we know everything is working, let's go through some housekeeping. This webinar qualifies for 1 CPE credit or 1 CE credit. CPE credit will be available within 24 hours in your CPA Academy account. And for attendees with a P10 on file, we will upload your CE to the IRS at a later date. You earn that credit today by staying logged in for 50 minutes and answering the poll questions. There will be 4 polls, and to earn credit, you'll need to answer at least 3 of them. I also wanted to let you know that we are recording today's webinar, and the archive, along with your credit, will be available in your CPA Academy accounts within 24 hours. And if you have to log out or log back in for any reason, our webinar software will keep track of your time. We also recommend you download today's presentation materials, which can be found over in the control panel's handouts tab. So now that we're all set, let's welcome our presenters. Eric and Cheri, the floor is all yours.
All right, everybody. Hi, my name is Eric Tuthill, and today we're going to talk about tariffs and transfer pricing, how to stay compliant and avoid IRS scrutiny. I'm here today joined with Ms. Cheri Valerio, and as Gabe introduced her before, she's a CPA here with Corporate Tax Advisors. I'm also a CPA here for Corporate Tax Advisors. Prior to joining up with Corporate Tax Advisors and taking more of a consulting type role, my past history is kind of more like a mid-tier, I would say. You know, BDO and BKD is kind of where I cut my teeth. So I did get a chance to do a lot more of this fancy international tax type stuff prior to starting my own firm. And thereafter, I had my firm for about 4 or 5 years before I kind of grew it and decided to get back into the consulting sphere. And so the way that I kind of look at these types of studies in international tax is a little bit more through the lens of the solo practitioner, whereas Cheri's going to look at this from a little bit more of a complex and more detailed type of scale. And so the way that, I wanted to kind of open this out with is just kind of give you guys a little bit more of an introduction on essentially what transfer pricing is, because I know we got a mix here. I know that the majority of what I see when we're doing these CPEs is we've got people that are here just to kind of get the CPE. We've got people here, who are interested in international tax. We've got people here that maybe, a part of a slightly bigger firm. We've got folks here that might be solo practitioners like I was for quite a few years. So we want to kind of put it in that lens. And as we're going through this entire presentation, we're going to start from a really high level scale, and we're going to kind of give you guys a little bit of an introduction on what transfer pricing is. And then we're going to get into a little bit more complexity type of transaction. So that way we can kind of look and see how the tariffs are really going to end up putting these things into play, right? So without further ado, I'm going to go through a quick introduction on what we're going to cover here today. And so, like I've said before, what I try to do is I try to put myself into the shoes of you folks here who are trying to learn something new today. And I'm trying to answer your questions for you, or at least the base questions that I would have if I was trying to listen to this presentation. And so those base questions are going to be, for example, what is transfer pricing and who is subject to transfer pricing regulations? Because it's one of those more oft overlooked type of studies that are performed by CPAs and are necessary. And the reason why is because you wouldn't technically say that there is a filing requirement for a transfer pricing study. However, it is a requirement for everybody that engages in international transactions. And so it is one of those more oft overlooked type of items that is necessary for every international taxpayer or multinational taxpayer. And so we're going to answer those questions for you, but then we're also going to answer, how do these incoming tariffs affect intercompany pricing, right? And what would the IRS really be looking for? And we can, as we go through this, you'll kind of see that the IRS is going to have a little bit more of a microscope on transfer pricing than it has had in the past for a lot of reasons, a multitude of reasons. And I think a lot of people here are probably familiar with why that might be the case, especially those of us with like economics backgrounds and backgrounds in international tax. I think we're all a little concerned with how people are going to try to structure transactions, and the incentives that and the motivations behind the structuring of these transactions, and how they might ultimately lead to very negative outcomes for taxpayers, right? And then we're going to look at how we can protect our clients and actually stay compliant as we're going through this process and adjusting to the new state of the world and the new state of how the administration is going to administer the various changes that are coming through. I mean, what was it, 2 days ago that we had a big drop from the Senate Finance Committee. So a lot of things are really in flux right now. And it's just kind of important that we get our ducks in a row so that we can address this with our taxpayers in a little bit more knowledgeable manner. So with that being said, I'm going to go ahead and hand over really quickly to Gabe for the first polling question.
All right, our first polling question has been opened up for our attendees and will be open for the next minute or so. So please get those answers in for us. I am available in the Q&A if anyone needs any assistance. And right back to you, Eric.
All right, well, thanks very much, Gabriel. So we're going to go ahead and answer the first, which is, what is transfer pricing? And as I said, I'm going to go through a real high level example of what it looks like from a profit shifting perspective, because I know it's been 15 years since I was in an international tax class. And so I know a lot of folks here probably are in around the same kind of sphere. Maybe it's been a while that you kind of refamiliarize yourself with what the rules are and kind of how this works and why the IRS would even be concerned about the intercompany transactions to begin with, right? So just a basic overview. The pricing for transfer pricing is really it's the pricing for transactions between related parties in different tax jurisdictions. So, for example, if we have a different tax rate in one country and a different tax rate in another country, we have another company in another country. It's basically the amount that we're charging that other company or that related party company in another country, right? We're not really so concerned about, say, tax jurisdictions here in the United States, and that's because we have water's edge elections. We have a lot of consolidated practices that are done there. We have apportionment that they kind of use to get around these intercompany transactions from a state-to-state perspective. So really, the focus is more on the multinational transactions, right? And it's really important here to note, especially if you're just kind of getting into this and just kind of understanding what transfer pricing is and does, but this pricing really heavily affects the ability of a jurisdiction to levy taxes and produce revenue. So it's going to matter a lot to the individual countries, and I'm going to show why that is here in a second with a really high 10,000 level foot view, and we're going to hit just some more kind of like profit shifting and kind of how that affects tax jurisdictions, right? So just looking at this really quick, I just wanted to identify, we've got a big consolidated corporation, Company Z, right? And Company Z owns Company B, they own Company A, right? There's two different tax districts. One has an effective overall rate of 30%, one has an effective overall rate of 20%. Company B produces something, let's just say a component of a widget, as most of our CPAs are familiar with the widget questions, right? They're producing a small component of a widget, right? And Company A finishes off the widget. Now, Company Z is setting the pricing between both the Company B and Company A, right? But net overall, they're going to end up with roughly around the same type of profit margin when you look at it from a consolidated perspective, right? At least for the sake of this example. And as Cheri is going to go through, it's a lot more complicated than that. But this just gives you like I would say the 10,000 foot overview of what this looks like, right? So essentially, when we have a pricing like this, and we're trying to, we might price things in a way that will allow us to pay the lowest overall tax, right? Because we know, hey, if I'm pricing things a little bit less in the higher tax country, my tax is going to be less, right? Than it could possibly be in the higher tax country, right? So if I'm looking at it from this perspective, and these are very high level numbers, right? We're using dollars here. But essentially, we get we calculate out, like in this case, when we price that company B at $3, right, versus some other higher amount, we're ending up with a certain amount of tax, and that tax in this example is like $1.30 paid per unit because of the price on company B, right, and how we're giving that price to company B. So instead, if we have $3 there, I mean, essentially, we're going to have a certain amount of tax, right? And our net profit is affected by how much tax is getting charged, especially in the higher tax jurisdiction country, right? And so that's kind of like the overall 10,000 foot view here of how this works, right? You have an intercompany transaction. You'll have a certain tax rate in certain countries. But let's just say, for instance, we realize that company B, instead of $3 per unit, like a comparable company, if company B did not exist and company A had to go out on the open market and purchase an item, let's say we call that in the industry an arm's length transaction, right? So if they went out and purchased it from another company B and it wasn't an owned subsidiary of company Z, and they went out and purchased it, it would cost them, say, $5. Right. So if that's the case and it ends up costing you $5, right, it changes how much tax is going to be levied in each jurisdiction based off of whether or not it's a arm's length pricing. If it's a price that is more conducive to a net overall lower tax situation, right? And so in this case, if we just adjust that pricing to the arm's length scenario here, which is $5, right, we end up with more tax, especially in tax district 2, a little less tax in tax district 1, right? But we end up with more overall tax paid per unit here, like in this example of $1.50 versus the $1.30 in the previous slide. So the amount that we charge from an intercompany perspective is going to adjust the amount of tax revenue that's received by a particular tax jurisdiction, and it's going to change the total overall profit margin that you can make as a consolidated corporation. So that is the 10,000 foot view here. And so I'm going to go ahead and hand it over to Cheri, and she's going to give you a little bit more of a detailed view of what this actually looks like, especially in perspective of the tariffs that we know that are coming. So she's going to give you a real life world example. So without any further ado, I'll give it over to Cheri.
Okay, so very common scenario. We have a U.S. company producing a final product. They're using a part that's manufactured and purchased from Mexico. So Mexico company and U.S. company are related parties, and they're both owned by a consolidated global company. And so Mexico has a 30% tax rate. U.S. has a 21% tax rate. We're going to assume that they're in a zero state income tax state like Texas or Florida. And so in the first scenario, there's a transfer price of $110. And in the second scenario, we have a transfer price of $55.56 that we computed that would be a 10% operating margin for the Mexican company, which is consistent with comparable manufacturers, and it satisfies Mexico's tax authority as well as the U.S. tax authority. So when we go over, you go ahead and move forward, Eric. Here it is, seeing the pictures. So the reason here in scenario 1, the parent has the objective of trying to shift profits to the Mexican company because they have the goal of reinvesting the Mexican profits. So sometimes, even though it's a higher tax bracket, companies might have a lot of different reasons that they want to, affect the prices of their goods. So the Mexican company, if they're charging $110 and the cost of goods sold is $50, then they have a price per unit of a profit per unit of $60, which is 55%. That's very high. And from the US perspective, you have $200 revenue per unit, the cost of goods sold $110 that you bought from the Mexican company, additional cost to finish out the product. Your profit per unit is very small. So you can see that the company was trying to shift profits to the Mexican company. There's only a 5% profit per unit there. And so the US is only getting $2.10 per unit, and they might not be happy with that. And so they might call on a transfer pricing study to test that $110 price per unit on the cost of goods sold. So I think you can go to the next slide. So what if global company did not own both of these subsidiaries? The US company would be buying from just any Mexican company, and other Mexican companies we can run through transfer pricing studies, earn an average of 10% operating margin. And if we do know like market prices, you can use that for a transfer pricing study, but oftentimes we don't know that. And so therefore, one of the common methodologies that we use is the comparable profits method margin. And so we want to see what would the transfer price be if we were buying at a 10% margin for the Mexican company rather than this inflated margin because they were doing price shifting. Well, I'm not going to go through all this math with you, and we have modeling software that we use, but the price per unit that we come up with that produces a 10% margin is $55.56 per unit, not $110. So that's a more arm's length price per unit. You can move forward. Okay, so what would it look like with the arm's length price per unit? Mexico would have $55.56. They still have the same cost of producing the unit. They now have a 10% profit, which is in line with their competition. So the Mexican government cannot complain because a 10% profit margin is comparable to other companies in Mexico for profit margin. But now, because they're selling, the US company is selling for $200 and they're having an arm's length transaction, what they could have bought from an unrelated party, the profit is much higher, and the US government is going to end up getting a lot more taxes for that product. They're going to get $13.53 in comparison with the $2.10 that we had in scenario one. So the US government's more happy with this, and the Mexican government has to, accept that it is a comparable profit margin to other companies. And a big picture for this company, it ended up very similar. The total tax per unit and the taxable profit per unit, but it shifted to the US from Mexico. So let's go forward. So basically I guess I just said all that, but the transfer price gives Mexico a modest profit at 10%, and it's comparable to the manufacturers. The US ended up getting a much higher profit. That's more fair to the United States government, reflects an arm's length transfer price. And then basically, if related parties their pricing strategies are not at an arm's length, it's called profit shifting or base erosion, which is shifting deductions. We can go forward.
And that's, and that kind of leads into, what I'm trying to, I really want to make it clear here, that the reason why the IRS is going to be so interested in what you're pricing your products as you can see, they make $13.53 here, versus say $2.10. So they're going to be extremely concerned with the outcome of how you're pricing products, and talk about how, and we'll get onto this in a few other slides down the way here, when we talk about why the IRS is going to be so interested and why things are shifting in that direction versus where we might have been in the past, it's going to be extremely relevant for what we're doing here. And I just wanted to address really quick, I think Curtis had a question here about the identity of product pricing databases and stuff like that. A lot of the times the transfer pricing study will actually be about profit level indicators. They're not going to necessarily be about a particular product price, right? So that the pricing that you end up getting, it's really about, like, say, net margin, or some other type of profit level indicators. It's not going to be necessarily about a particular pricing of a product, right? It's going to be about what the net outcome is, because like, say, in this case, both the United States and Mexico are interested in technically what's fair here, right? And how these profits should be allocated between all these types of countries, right? And so that's where we talk about what comes next here, which is economic cooperation, right? And I did want to point this out really quick. I didn't misspell organization. That is the British spelling for it. It's Organization for Economic Cooperation and Development. That is the kind of the ruling body that we're part of an association of. It kind of helps dictate how all these particular countries are going to get what's fair or what is owed to them, right? Based off of these particular tax rates and based off of how things should be allocated, right? So that people aren't doing things like profit shifting, like we were showing before. If you shift your profits into another country, why is that going to have a negative effect on the opposite country that you're shifting profits from, right? That's who we really want to make sure that, I mean, that's when the IRS is looking at it, that's really what they want to ensure, that the United States is getting its fair share, right, of its taxable revenue, right? And that's really what we're looking at here. And what the majority of this presentation is about is why that's concerning, and why all this tariff talk and all of the stuff that's going on is really concerning for international taxpayers. And it really boils down to, trying to get a share of the tax revenue, whether that's through tariffs or whether that's through income taxes. They're basically trying to raise revenue through these changes that they're making. So all this stuff, all the OECD stuff really boils down to, they want it to be arm's length standard, right? And they really want it to be as if you were going out on the open market and buying that product somewhere else, right? What would the fair pricing be? Right. And when I say that, I'm referring really to the arm's length standard. And it's funny when you look at the OECD member countries that we have here, there's a couple of really big powers that are missing from this list. And one of those notably being China, and the other one notably being Russia, right? So those people are not participating in these types of arm's length transactions, which leads to things like instituting tariffs. And so that's probably part of the reason here that tariffs were instituted to begin with. I don't know all those kind of details, but I would say that there was definitely a concern in the United States that they weren't getting their fair share of revenue pushed over to the United States, right? So I think for me, this is one of the bigger aspects of this whole presentation, really. And that's, because I know I'm talking to a lot of solo practitioners here. I know I'm talking to, maybe some mid-level practitioners, maybe some CFOs and stuff like that, that might have let this particular aspect go in the past, right? Maybe they weren't unaware of it. They may be, maybe there's some type of just lack of knowledge as to what's required here. Or a lack of knowledge as to what the penalties could possibly be, associated with not performing a transfer pricing study. And I think that this is one of those aspects that when I was in private practice, I would kind of talk to them about it a little bit. I would let them know what the requirements were. I would also let them know what the price was of doing a transfer pricing study. And especially for those guys who are new to the country and just trying to get a toehold in to the country, a lot of the times, I was a little bit more lax on kind of letting them get away with not doing it, which I know, you might have faced that kind of thing in the past, but we really need to be more adamant as tax advisors here that the repercussions of not doing something like this, especially if you believe that they're going to be a little bit more under the microscope than they might have been in the past. You just can't let this one fall to the wayside anymore, because it's going to be a big issue for them. I think they're going to shift priorities and shift budget allocations from the IRS to, you call it almost like an external revenue service, right? Or maybe somebody could tweet that out somewhere. But essentially, you would have like this. You would have a lot more pressure on the IRS to perform and collect revenue, and they're going to try to collect revenue whatever way they can, and they're going to try to take the microscope off of the individual or business taxpayer, and they're going to try to move that over to more of the international taxpayer, right? And so the people who need to comply with this, right? Any taxpayer that engages in transactions with related parties, especially multinational transactions. I should say it really is just multinational transactions that we're really concerned with, right? And so a lot of you guys are familiar with the tax forms that you might have had to file, and we've probably thought about this before. It's like, okay, well, it's $10,000 a pop for failure to file some of these some of these specific tax forms, like the 5471, 5472, 8865. 926, 1042. Like, a lot of us are familiar with filing these forms or have filed these forms for our taxpayers of the past, especially folks here who are really familiar with international tax. Most of us know all about that stuff. If you have one of those forms in any of your files, your taxpayer needs to have a transfer pricing study. And I'm going to show you exactly why it's so bad to not have one here in a couple slides. But basically, these are the guys who you're going to be looking through all your list of preparation for, and you need to have this kind of conversation with them as quickly as you can, especially seeing as how we're halfway through the tax year and these tariffs are likely to stick. So the U.S. definition of related parties, a lot of this is in 482, and a lot of the subject matter that we're going to talk about today is in 482. And so these specific, they're basically, your U.S. corporation with a foreign subsidiary. So if you own a company out offshore, if the company offshore owns a company here in the United States and they're trying to work with something, those guys are going to be relevant to this. Those are the people that we do 5471s, 5472s for, and then brother sister companies as well, right? So our examples that we had previously, Global Co, right? Those are brother sister, parent subsidiary structures. And then the other thing that is sometimes overlooked here is usually like individuals that own these companies. Is if you look through, right, that's part of the 5471, 5472. If you look through, you got to report the individual shareholder information, et cetera. And it's important to note that this isn't just corporations, right? This is everybody. This is partnerships, LLCs, trusts, branches, permanent establishments, any type of these entities, right? And a lot of people don't understand the type of transactions that we're really looking for and what is going to be the red flag here. Sale or purchase of tangible goods. That's the easy one, right? So that's manufacturing operations where you're finishing off the widget here in the United States or wherever else, right? Provision of services. That's one that is definitely often overlooked. And sometimes we talk about the base erosion minimum tax that was in the new law. But essentially, it's if we're trying to shift deductions over to a different country, we call that really base erosion instead of profit shifting, right? So that's going to be base erosion. And a lot of times you charge, say a management fee or something like that to try to move deductions over to a particular high tax country. So those are the same things as doing profit shifting, right? It's an equal outcome. And then you also have things like, a lot of people aren't familiar with this, but you have to kind of charge a price here for the use of intellectual property, right? Or licensed property. So if you are using technical know-how and stuff like that you've accumulated in another country, that's going to be one of these types of transactions that needs to be accounted for when you're starting a new company here in the United States to say profit off of these things. Same thing with intercompany financing, right? So loans, guarantees, and I mean, you do 1042s for this all the time. It's essentially, that's another way to remit profits, if you will, of the foreign company. So we see that a lot, and cost sharing agreements, management fees, and other intercompany charges. These are all things that are looked at from the IRS's perspective because they want to make sure that you're not shifting profits overseas. They want to make sure that you're not shifting deductions even overseas, right? So they want to make sure that they see that that stuff in your transfer pricing report, right? That is the end all and be all what they're really kind of looking for. All right, and with that being said, I'm going to hand it over to Gabriel real quick for polling question number 2.
Alrighty, polling question number 2 has been launched, and it will be open for the next minute or so. I'm available in the Q&A if anybody needs any assistance, and right back to you, Eric.
All right, so now to the next kind of component here, and that's going to be how do incoming tariffs affect transfer pricing? And I'm going to hand it back over to Cheri. She's going to look at that, like I said, from the more in-depth perspective for the internationally tax experienced folks.
Yes. So in our scenario 1, when the global company is doing the profit shifting to the Mexican company, we have a revenue with no tariff at all. We have a revenue per unit of 200. We had the $110 cost per good sold from the Mexican company. And so our profit was only 5%, and the US government was getting $2.10 per unit. But in the event that there is, say, a 10% tariff, the company has a choice. They can either absorb the cost or they can raise prices. And so I gave 2 different options here. They keep the cost at $200 per unit and they absorb the cost. So the cost of goods sold with the 10% tariff now becomes $121. Well, that net profit per unit is now negative. So the government now is getting 0 tax per unit, but they're getting an $11 tariff. They're getting that 10% tariff on the cost of goods sold. So, they're going to get it. They're going to get their tax revenue no matter what. They've figured out that when companies are purposely messing with their prices, they can use tariffs to generate tax revenue. So if you are able to raise your price by the $11, so your cost of goods sold goes up $11 for the 11 for the tariff, or $11 for the tariff, and then $11 price per unit goes up on the revenue. You're able to pass off the whole thing to the people. Your profit per unit is still $10, so you've just passed that along. In reality, it's probably going to end up being somewhere in the middle. You might not be able to raise your price enough to cover the whole tariff, but you have to see what the market will allow. So in this scenario, the tax per unit still stays $210. Plus, the U.S. government is getting their tariff revenue. So the U.S. government now is getting $11 tariff plus the $210 because you were able to get that tariff in raised prices. So unless they're able to raise prices, the unit's going to go unprofitable, and the U.S. revenue goes from being not very fair in their eyes to significantly higher. So now we can move forward. So after the transfer pricing study, and we realized that the Mexican company should have only been getting approximately a 10% margin, the manufacturing company in Mexico, if the US requested a transfer pricing study, and we found out the price really should have been $55.56. If they were buying from a different company in Mexico, not the related company, they would be paying $55.56. And so that gives a profit per unit of $64.44 with a 20% tax rate is $13.53. You can see that's a big growth over $210. And so, the US government is happy and the Mexican company is happy, or the government is happy because 10% is the standard margin in Mexico for this type of unit. But here comes tariffs. If you have a 10% tariff on the cost of goods sold and you decide you're going to absorb the cost, then your profit margin drops down a little, 29%. And then your tax per unit's $12.37. Your drop in profit is $4.39. That's just how the math works out. So what is the US government getting in this scenario? They're getting their $5.50 tariff plus $12.37 in the income tax. If you're able to shift that along, the price increase, if you're able to shift the price of the tariff, you get $205.56 in prices, the revenue per unit. And the cost of goods sold is $61.12. That includes that tariff. And the net profit for the US company is $64.44. So you were able to maintain what you had to start with because you were able to shift that cost out to the consumer. So the US government at the end of the day here is going to get their 556 tariff plus 1353 because there's a price increase. So you can see why the US government is really going to be on top of this. If, you know, they can shift from going $2 per unit to $19 in tax per unit while still maintaining the 10% comparable arm's length price in Mexico, they're going to be very interested in doing so.
Oh, sorry, I'm trying to hit the button here and it went to so, you know, I'm still trying to point this out here, you know, like how we price products is extremely important to the IRS, right? And my high level view here, you know, we're looking at tax per unit here for company B, right, at 30 cents versus tax per unit at company A at 90 cents when I was doing the more simplified version of my example here. You know, it basically will heavily affect how the IRS is going to look at a lot of this stuff. I mean, there are folks here, there are probably some folks here that have been through these types of audits as well, right? In terms of how the transfer pricing works. So, I mean, they can do a lot of things to you, especially if you don't have a transfer pricing study in place. And like I said, we're going to start going through that right now. But I did want to take just a moment here to talk about why, you know, the government focus is going to be so heavily on international companies in this particular realm right here of transfer pricing, where it hasn't necessarily been as big of an issue before. And you know, that boils down to a lot of things. You know, the IRS's budget has been, you know, somewhat limited. When they did increase it, it was actually over this last few years, it was really more to enhance the IRA provision, right? So they passed a lot of tax credits and initiatives there. We call that the green tax credits that they pass, or, you know, it was compared to the Green New Deal type of tax credits, right? Those are the IRA credits. When that was passed, they increased the budget of the IRS with the whole goal of offsetting those credits with increased revenue from U.S. taxpayers, right? And that was one of the bigger focuses and aspects of what they were doing. They weren't focused as much on the abroad type of audits, and we definitely saw an uptick in audits, I think, overall, when they did start increasing the budget there for the IRA. And especially, like, a lot of people know that they didn't pay out ERCs, and they probably didn't pay out ERCs for a lot of reasons. One of those is probably because they were trying to show the benefits of employing so many more IRS agents, right? But, you know, going back to my example, that's how much is charged to the foreign company. It's going to directly affect tariff revenue, right? That's why it's so important. And that is being one of the big priorities of this administration and of the folks that this administration is putting into place, that they're going to want to see something that shows them that this is being effective, right? And so when you look at what they actually have available for them, you know, they're going to have different people for like the actual collection of tariff revenue, but the Internal Revenue Service is going to play a huge part in being able to collect these tariffs in the way and manner that they're kind of trying to look for, right? And so the way that they have to effectively do that is through transfer pricing audits and audits in general on foreign companies, right? So you're probably going to see more of an uptick in general for these folks, right? And we could see that what they're trying to do here is they're really trying to put these in line with a domestic directive to motivate domestic production and economy, right? And then also, I mean, in order to do that, you kind of have to say, okay, foreign companies and stuff like that, we kind of have to have unfavorable things because we're trying to drive more business to the United States from an economics perspective. And so if we're trying to do that, we're going to do a couple things to try to motivate and stimulate the economy here from a domestic perspective. And you could see it in the tax bill that they just released, right? So, I mean, or the update to the Senate Finance bill that they're trying to get passed through Congress, right? You can see that they're trying to motivate production in this country by giving people extra credit, right? The advanced manufacturing investment. So they're trying to move more manufacturing here in the United States. They're giving 100% bonus depreciation, right? More cash in hand of domestic entities so that they can spend that money more locally and domestically and try to catch up to the rest of the countries, right? And they restored R&D. R&D issues that have been on the books for like the past 2 to 3 years. They finally are trying to correct that. And trying to stimulate that investment in research and development here in the United States, while penalizing foreign investment, where foreign investment in R&D is still going to be subject to the 174 standards. And then we've got the overall reduction in the IRS budget, which they've already kind of cut from the IRA prior to this. But then there's also things like no tax on overtime. Why would there be no tax on overtime? Well, they're trying to stimulate more GDP, more growth per person here in the United States than before, right? And then at the same time, we're also seeing the unfavorable foreign policy and enforcement, right? So tariffs, I mean, that's the biggest evidence that they are really more concerned about stimulating the economy domestically than they are with some of these more broad laissez-faire tactics, right? We're also seeing a BEAT increase, right? So from 10% to 14% for the base erosion minimum tax that we're seeing in the bill, right? There's a lot of guilty and foreign tax changes that are in that bill right now. So I know there's practitioners on. You guys, we will be sending out a newsletter here later on. In that newsletter, we can highlight what those foreign tax changes are as well, and give you guys a little brief overview of what that looks like. But the other big thing in that bill itself, it says remedies against unfair foreign taxes, right? So there is definitely a concentration on limiting, the foreign policy and enforcing that kind of component than it is going after small business taxpayers or United States taxpayers in general, right? There's definitely a shift in where you could believe that the IRS would have its focus. Like the decline that we've seen, from IRS agents, definitely off of where they would have focused more domestically. And I believe that shift is going to change a lot more because they have goals that they're trying to achieve and show to the rest of the world, right? And it leads to pressure to make up the budget shortfall through external taxation, right? The External Revenue Service. And I already made some comparisons to the IRA actions, but these are the reasons why you can see cumulatively from an economic standpoint, they're going to be really focused heavily on enforcing these things. And they're going to be, from the IRS's perspective, what is the IRS going to do? They're not going to go necessarily after small businesses. They're not going to go after United States core businesses. They're going to focus on getting that tariff revenue to a level that makes sense for them. So that's why transfer pricing is going to be such a big deal to the IRS and how they're going to try to look at this, what kind of lens they're going to look at this from. And so that being said, we're going to say, well, what if we don't do this, right? What if do we have to comply? What if we don't do this? Well, the penalty here, this is one of the unique elements of the tax code. There's not a lot of places where the IRS can just do whatever it wants. And that is one of the most unfortunate things about this. If you don't have a transfer pricing study in place, the IRS can essentially, and they still can to a certain extent, but the IRS can essentially do whatever they want to your profits and allocate things however they feel is fair. And so you're going to get a NOPA that basically a notice of proposed adjustment that is going to say, well, we think it should have been this price, right? Especially if you don't have a transfer pricing study in place. And we'll go through the IRS FAQ and kind of what they're looking for from a transfer pricing study perspective. But they can go through, they can increase taxable revenue by recharacterizing it through these intercompany transactions. They can disallow deductions like those management fees that you're trying to push overseas. They're really adamant about this being arm's length, right? They can shift your profits back, all kinds of stuff, right? And not only can they do that, but they can put penalties on top of that, right? And severe penalties, 20 to 40%, depending on the severity, right? But one of the cool things is if you actually have a transfer pricing study, you get these penalty reliefs, right? You're not necessarily as subject to these accuracy related penalties unless you can prove, there's some fraudulent intent behind all of this stuff. But you basically get almost like you would say, get out of free card on the accuracy related penalties, right? And this is very specific, and it's in that in 6662E, right? It says, if you meet the principal, contemporaneous documents, component of this, you kind of get a little bit more of a leeway here from a penalty perspective if they try to levy something like that, right? So that's a huge thing. And then you also have to have this in place by the tax return due date. If you filed it before, I mean, your transfer pricing, it's not going to give you, if you filed the tax return before you finish your transfer pricing deal, it's going to, you could have problems with the accuracy penalties, right? They could levy that on top of it. So those are very important to kind of understand how that really works for. And with that being said, I think we're going to move on to the polling question number 3. Gabriel?
All right. Poll question number 3 has just been launched for everyone, and it will be open for the next minute or so. Please get those answers in for us, and I'm going to turn it right back over to you guys.
All right, so let's go into what the IRS is looking for and how do we comply with what the IRS is looking for. And there's an FAQ on this on the IRS's website, so we really want to, of course, there's the regulations and everything that we're trying to comply from a legal perspective. But at the end of the day, if we're going to be coming under audit here, we kind of have to look at this through the lens of the IRS, because this is what they say that they'll take you to court on or they won't take you to court on, right? And so in this case, they're looking for a transfer pricing report that does these things, right? Appropriately documents related party transactions, uses an arm's length standard, which we've gone through in detail, uses an appropriate transfer pricing method supported by analysis. So that transfer pricing method, is one of those accepted type of transfer pricing. So if you go through the regulations, there's PLI indicators, et cetera, that kind of help us figure out what that transfer pricing method would be. And it depends on the transaction that's taking place, and a lot of different factors when you're looking at that. But essentially you have to pick one of the right ones that is most reasonable in nature given the circumstances of the transaction, right? And then you have to have this contemporaneous documentation. This is a big thing here for this pricing standard, and that is essentially, right, if I were to put an equal sign right next to that, that is the transfer pricing report, right? These are all the factors that are included in a normal transfer pricing report. And that would be, first of all, we have to have it in place before the due date of the tax return, like I was saying before, but you'd have an overview of the business and industry, a description of controlled transactions, a functional analysis that goes through all the functions, assets, and risks of the company and the transaction specifically, right? The method of selection and application of an appropriate pricing method, right? So how did we choose this? Why did we choose this? And then an economic analysis. So we're looking at what other entities that are out there that might have a similar type of transaction in nature, and any of the comparable kind of PLIs that you would use to compare that to, right? So why did we choose what we chose? When we're going through that whole process of looking at different companies and what they did, that's an extremely important part of how the reporting is. And they're going to look to see that it aligns with the 5471, the 5472, the transactions that we know they're reporting elsewhere. And if you guys are curious as to a lot more of the basic type of details as to what the IRS is looking for. And I shouldn't say audit techniques guide, right? Because the LB&I does things a little bit differently. They don't really publish these audit techniques guides, but they do have a transfer pricing examination process. That's because it's most of the time for a lot larger type of companies. But it's a publication 5300 that really kind of outlines what they're looking for in really heavy detail. It's a lot of pages long, and it's good bedtime reading, right? Okay, so when you go to the IRS FAQ, they basically tell you, robust documentation helps avoid scrutiny. So they're saying if you have one of these transfer pricing, studies in place, you might even be deselected. You might lead to early deselection from audit, right? So having one of these things in place, basically tells them, hey, we really don't have we don't have a place to go, or it's going to take substantial time to compare this ourselves and go through this whole process. Maybe we go find easier pickings where we have people that don't necessarily have these things in place, right? And so it could lead to early deselection, which is nice, right? And then you want to make sure that you're looking at you want to conduct a self-assessment, right? And just, especially if you're the taxpayer yourself, right, and not necessarily the people who are doing and preparing these things, you want to kind of understand how this works, right? What a sensitivity analysis on comparables, are there other comparables that could be possibly pushed into this situation? Am I opening myself up to possible adjustments in the future, right? You want to look at all the profit level indicators really that that you had or you in order to make this pricing work for the company. And you want to ensure that there's consistency about those profit level indicators. You can't just choose one thing arbitrarily one year and one thing arbitrarily the other year, because that doesn't look right to the IRS. It looks like you're trying to profit shift or you're trying to do base erosion, right? And so you want to understand how profits are shared also across these related property. You want to preemptively address these IRS questions, right? I mean, that's the whole thing, right? And you want to follow the arm's length standard precisely as you possibly can, right? And if there are cases where you can't find some kind of comparables, but you can look at things from at least from an industry type of standard, and you can kind of draw back from there. But there's a lot of times where you can find something that's pretty close. Maybe we have to make a couple leaps in judgment, here and there, but you can find a lot of transactions that are going to be similar in nature. So you can kind of look at what those look like, especially from the big databases, which you use are mostly publicly traded type of companies. There are private databases that are used as well, right? When you're trying to figure out what these ratios are going to look like. But you want to evaluate why you used a particular method and why you didn't use a particular method. You want to document the search process. I mean, these transfer pricing reports, if you look at them, they're basically a whole detailed narrative of, we pulled up this database, we looked at this, we rejected these guys for this reason. So you have to be very specific on why these things are done. And then you want to make sure that, like, how the comparability adjustments were made, a whole bunch of stuff, right? And then you need to make the documentation examiner friendly. So that means, concluding these clear industry and company overviews. You want to make sure that it's easier to read and easier to understand. And you want to make sure that the comparables are effective. Like I was just mentioning before, you want to make sure that those are really fitting in line with the transactions that you're working with. And you want to make sure that the data you want to give the IRS everything that you can to make sure that they are as equipped as possible, that you've done and reasoned out everything as much as possible so that you can hopefully avoid any negative adjustments, right? So with that being said, I'm going to go ahead and hand it over to Gabriel here for polling question number 4.
All righty, polling question number 4 has just been launched for everyone, and it will be open for the next minute or so. So I'm going to turn it right back over to you. And once again, I'm in the Q&A if anybody needs any assistance.
All right. So this is really the point of all this, right? And the point of why we're concerned here is we eventually have to sit in front of our taxpayer. We have to say, okay, well, we need to make sure that these bad things that we know could possibly happen don't happen to you, right? And we need to advise them. That's what we're called, right? Advisors. And so we need to understand, how do we protect our clients and stay compliant with all these scenarios, right? And so, especially from an individual or solo practitioner type of view, or if you're, with a medium-sized firm or so, you really want to make sure that you're looking through tax returns that you filed in the past. You've probably got a couple C Corps in there, I'm sure. It depends on what state you're in. You probably have a little bit more if you are in particular states than other states. You might have more S Corps and things like that, right? But you'll want to look through all those, and you want to identify when did I have to file 5471s or 5472s or the 8865s, right? I mean, those are the more common ones that you'll see in most of these scenarios in any way. So you should know those ones, and those ones should stick out to you, because, man, it's $10,000 a pop if you mess those up. So you should have done them pretty well. You should have reported those pretty well already. If not, time to re-examine them, because they're probably going to be under focus a little bit more than they have been in the past. And you want to sit down with your taxpayer and have a real open discussion about tariff planning and foreign tax updates, right? And the Senate bill that's coming out, there is a lot of foreign stuff in there, right? A lot of controlled foreign corporation stuff that's in there, and who gets the tax credit where. And like I said, there's a remedy against unfair foreign taxes. There's going to be a lot of different things that are in that bill that's already coming out that could affect, say, a transfer pricing situation, or your international tax guys as a whole, right? And so for the taxpayers that don't currently have transfer pricing in place, right, you need to inform them of the requirements to maintain contemporaneous documentation. I think we had a couple questions in here. There's no minimum, guys, and then there's no change here. This is already in place. These regulations have always been here. You might not have been advised correctly in the past, but now is your time to understand that this is the time to get these things in place. And if you don't have these things in place, you need to get them in place as soon as you can, because like I said, I think things are going to start altering heavily. People that might have been protected because they're like, well, I'm not a big corporation, or I'm not a big guy, or why would the IRS pull me? I think they're going to pull everybody that they can, that they feasibly can, right? And they're going to shift a lot more people over there, and I think we're going to see a lot more people with a better understanding of what this looks like and how to audit this as well from the IRS's perspective. So we also need to talk to these folks about how to inform them of the current state of the American economic policy and how this government scrutiny is probably going to come in place. Like I'm just saying right now, there's a lot of reasons to be concerned that your international tax guys might be a little bit more under attack than they have been in the past, right? And that they might need to make different steps. They might need to move operations here. So this is the perfect time to advise and strategize, right? And get some consulting fees, right? Because there's a lot to talk about, right? There's a lot of things to go that are going on right now. And if you guys don't have that expertise, it's always appropriate to meet with, get appropriate professionals to get the documentation together. And of course, we always like to say that we're one of those appropriate professionals that can help you kind of work with your taxpayers. And just talking about how we kind of perform business here. We do a pricing preliminary analysis, right? So we just do an introductory call. And in that call, we just kind of go over the situation or the taxpayer situation. We can do it with the taxpayer, with you present. We can do it with the taxpayer on our own. However you want to arrange that, especially as a practitioner. We can help out in that range. And then of course it's a normal standard kind of process. We go through and do our information requests and we gather our documentation and things like that. We go through the whole process of the pricing study and ensure that we're within arm's length transactions. If not, we talk about how to best address that, especially if it's in retrospect. And then we do the final study delivery, the final report delivery. And of course we always stand by our work. And that's how we do audit defense, right? So if you're ever selected for an audit, we got lawyers, we have ourselves, and we come with the best thing that we possibly can to try to get everything squared away for you and get it as least costly as possible if you are selected for an audit. And so with that being said, I'm going to go to Q&A here, and I think we covered two of them there. And I'm not sure here, Cheri, can you see the question there? I think it's the Mexico example.
Hold on.
So it says, in the are you seeing that, Cheri?
I don't see the questions. No, I don't see. I was on full screen and now
okay, let me read it for you. It says, in the Mexico example, why would they have preferred to transfer the profits to Mexico as in the original example? By not doing the improper transfer pricing, they end up paying less tax and have more after-tax profits.
Yeah. The point of that was just to show that there's sometimes, globally they are going to be paying more tax, but they had an internal desire to transfer profits to Mexico. They wanted to reinvest in some of their buildings in the manufacturing process there and to keep that pricing structure going forward.
So
I mean, it was just their internal goals.
So I would say it's a way of moving investment over there without necessarily making a loan or making a contribution to them, right? And after tax
for reinvestment, just for reinvestment.
So
that could have gone the opposite direction, that you were undercutting, to get the profit to Mexico, to the United States. So it can go the opposite way as well.
Does transfer pricing apply to CPA firms that use offshore labor? That's a good question. I mean, do you own the company? Do you own a company over there with offshore, or are you using them as contractors? Because if you're using them as contractors, that's just a deduction, right? So if you actually own a company over there where you're set up and employing them, yes, absolutely, that would apply, right? So that would be. It depends on how you got it set up. I don't think. I don't think you necessarily would be worried about it if you're using them as contract labor.
down to our last minute, so we probably have to shift
Oh,
back.
yeah, no, I have
to
to give it to Gabe. I'm sorry, Curtis.
Yeah.
I'll try to answer your question here a little bit later on, but I'm going to go ahead and give it over to Curtis to wrap this. I'm sorry, to
wrap it
Gabriel
in.
to wrap this up. Sorry.
All righty. No worries. No worries. Thank you so much, Eric and Cheri. We really appreciate having you with us today. To wrap things up for our attendees, the handouts, archive of the webinar, and CPE credit will be available in your CPA Academy accounts within 24 hours. CE credit for attendees with a P10 on file will be uploaded to the IRS at a later date. And if you look in your email inbox, you will find an evaluation link for this webinar. So please let us know how we did. All questions asked today will be forwarded in a full report to our presenters. Thanks again to Eric and Cheri for your great content and to our members for participating today. Please check the schedule on our website for additional information, and we hope to see you on a future webinar. Have a great day, everyone.
Thanks, guys.